check this out. The stock market achieved something it has not done since 2001. 9 straight days of more stocks dropping than going up. That is negative breath. All while the NASDAQ has made a new all-time high yesterday. Guys, this makes me a little bit nervous. You can also see this in the RSP. The equal weight S&P has been red now for pretty much 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days in a row. If you include 11, you've technically been green 2 days out of the last 11 trading days. And the one green day you had here was on December 11th, and the other green day was on November 29th. You are seeing a bloodbath in the equal weight S&P. In fact, on the equal weight S&P today, you're sitting at your 50-day moving average. You're 1 penny higher than your 50-day moving average. This average is at $181.83. Right now, the RSP is at $181.85. So now you're 2 cents above your 50-day moving average. That does not look good. The last time we broke below your 50-day moving average, this was in early August when you had the yen carry trade that was blowing up. You did end up falling about 2.5% lower than that, but the broader S&P went into a 10% correction. And if you don't find support at the 50-day moving average, historically, that leads to larger downside. So I'm a little nervous today as you're sitting right on that 50-day moving average. If you don't find support here, next stop's that 100-day moving average. And I don't see how the S&P would not be affected by a breakdown in the equal weight S&P. Okay. They tend to, follow to some degree. So yeah, I'm a little nervous heading into next week. We have a lot of data. We have the Fed, you have retail sales, you have PCE, you have all kinds of different things that we'll go over throughout this video. But that in a nutshell is why I'm a little concerned. Now, heading into next week, you do have some earnings to contend with. On Wednesday, you have General Mills, Pre-Market, and Birkenstock. Wednesday and after hours, you have Micron and others. And then Thursday is going to be your bigger day. You have Accenture and Darden Restaurants, as well as Paychex, Conagra, CarMax, and Cintas Pre-Market. And after hours, you have Nike and FedEx. FedEx is seen as really a bellwether company to the economy. FedEx last earnings report was not good, and what the CEO and CFO said was just not comforting. It was pretty alarming, right? Last quarter they said, you've seen the Fed did 50 basis point rate cut. I mean, that shows just how weak the economy is. Like when FedEx's top, people, top, officers and executives are saying things like that, it doesn't lead me to be very confident about what FedEx is going to say this week. And I think that is a potential issue that markets could be facing. But the economic data for this upcoming week, well, there's a lot of it. Okay, we clearly know we have the Fed on Wednesday, December 18th. But even just to start off Monday, you're going to have your PMIs, your global composite PMIs, for December, your manufacturing PMIs and services PMIs. Any weakness here, I don't think is going to be taken well, right? Because our expectation is in 2025 that PE multiples can be at the highest they've been at in decades because the economy is going to be so strong. Because we're going to have all this deregulation. All of these things are supposed to go right. If we start to get weakening data, that's a problem. Now, we've seen a high initial jobless claims number. We've seen some weaker data over the past couple of days that markets have kind of shrugged off. But this week, if we get bad data, it's going to be hard to ignore, okay, for this upcoming week. Tuesday, you have retail sales month over month, expecting a really good number there of positive 0.5% month over month. People spending money is about 70+% of the economy. So it's vitally important that people are still spending money. Okay. A miss in retail sales would be really bad news for markets. It would likely lower 10-year treasury yields, though, and that could be a positive, at least a little bit for markets. So we'll see. On Wednesday, you have building permits in the morning, and then you have the Fed at 2 p.m. You have the rate decision. Everyone's expecting the Fed is going to cut rates. Like I said in the last video, there's like a 99% chance the Fed's going to cut rates and only a 1% chance that the Fed pauses. So they're going to be cutting rates. That's not the surprise. The economic projections, though, the Fed's dot plot could get very interesting. There may not be much of a change here, or there could be a big change here. Okay, we're going to get GDP projections, unemployment projections, Fed funds rate projections, inflation projections, a bunch of different projections coming from the Fed, and the markets tend to react to this a lot. And really for a couple of days, the markets will be latching on to that. So I think that is a risk that we have for next week, given how strong the markets, relatively speaking, have been since the election. I know not all areas have benefited the same, right? The banks have went up a lot. Maybe consumer staples have not went up as much, right? So it's kind of been a bifurcated market, but generally speaking, things have been okay. We do have final numbers for GDP on Thursday. Existing home sales, some Philly Fed data, smaller data in here. The inflation rate out of Japan Thursday. And then on Friday, we have core PCE month over month, expecting 0.3%, so a pretty hot number there. Personal income month over month, expecting 0.4%, a deceleration from last month. And personal spending, again, alongside retail sales, very important data point, is expected to go up 0.5%, month over month. So we have pretty high expectations that the economic data is going to be good for next week. In the off chance that the data weakens, that would set us up for a pretty weak second half of December. Now, historically speaking, the second half of December tends to be very strong. From December 15th through December 31st, the S&P historically rallies about 1.5%. Like, could that happen again? Of course. But I think the risk is growing that we may not see that kind of year-end rally. And on a probabilities metric standpoint, there's probably a 70% chance, 65% chance that we rally into year end, and a 35% chance that we don't. I would say those odds have went up a little bit in the past couple of days. I would say 2 days ago, it was looking like the odds of a year-end rally was like 80%, and a correction or some kind of drawdown into year-end was like 20%. So it's went up a little bit in the past couple of days, mainly because of this. One, here you have the percent of stocks trading above their 50-day moving average. Today, it got destroyed a bit. You're down to 52.51%. 5% of stocks today fell below their 50-day moving average. That's not good, especially on a Friday. That signals quite a bit of risk-off activity. People are uncertain. They don't want to hold some positions over the weekend. A saying that you may have heard in the markets before is down Friday, down Monday. Okay? If Friday's down, Monday tends to be red more times than not. And yeah, it just doesn't look great today. Also, when you look at CNN's Fear and Greed Index, the headline number today is at 50, which is exactly in the middle, exactly neutral. Yesterday, you were at 48, but today the markets are worse off than yesterday, so I don't know exactly why that's happening. Market momentum is in greed, but look at this. Stock price strength has deteriorated, okay, in just the last couple of trading days specifically. This is the net new 52-week highs and lows on the New York Stock Exchange. You're at 4.11%, right? You're getting to some pretty, bad levels for the index to be this high. Stock price breadth, you can see the McKillen volume summonation index is hitting some of the lowest levels you have seen since August, when we had a bit of that flash crash, right? You're getting down to some of those same breadth levels. Again, for 9 days in a row, you've had more stocks declining than rising on our markets, but yet what has happened over the past 9 days. Markets really have not moved at all, right? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 days ago, you were sitting at roughly the same level that we're at today. Almost exactly the same level, okay? But you've actually seen stocks fall over the past 9, 10 days or so. I don't think that's great. It really just means, like, think about it like a pier, okay? A pier on the ocean, whatever it is, wherever it is, okay? It could be Jersey, it could be Florida. You got a pier, right? There's a bunch of, wood beams that are holding that thing up. And over the past 9, 10 days, we've been knocking some of them down, okay? That's fine if things stop and we can kind of rebuild those and gain some momentum again, great. But if you get a hurricane that's some bad data, aggressive Fed, right? It comes crashing down. You start knocking out some more of those. In simpler terms, what I'm trying to say is the markets have grown weaker in the past couple of days. We have not seen this divergence between breadth and price since 2001. Now, this only does so good because it's not a 100% indication of weakness coming. And even if we do get some weakness, like, are we going to crash into year end? Probably not. Like, I still think some kind of 10% drawdown in December is pretty unlikely. I don't see a catalyst for that at this point. Again, unless the data is really weak and there's a growth scare next week, which, how likely is that? Probably not that likely. Could the Fed be more aggressive, more hawkish than we think? Yes. Could that cause some kind of downturn for markets? Yes. How confident am I that the Fed wants to, change their stance aggressively next week? I'm not that confident in that. That's why I think while the odds are low of a, rough second half December, they have risen a little bit recently. The structural foundation of our markets has weakened. Now, that could all change next week. Things could go back to being super bullish. That's certainly a possibility. Okay, I think just getting the Fed out of the way, whether they are a little bit more, hawkish than we expect or whatnot, it's bullish, right? Because we're eliminating a risk catalyst. And after next week, we get retail sales, we get personal spending, we get PCE, we get your flash PMIs, we get finalized Q3 GDP data. Like, there's a lot of risk catalyst that will be gone after last week or next week. Okay, so from that standpoint in and of itself, I think that's positive, okay? Because markets want to go higher. People are bullish. So knock those catalysts out, we could definitely move higher following next week. And that's why I think it's a 65-70% chance of a pretty nice year-end rally here. Again, going back to what we're seeing in the RSP for an example, yeah, there is a cause for concern here that a further breakdown could start to really be negative for our broader markets, like in, SPX or SPY for that matter, especially heading into a week like next week. This is a lot of red candles in a row. I can't even recall the last time you've seen this much red for the RSP consecutively. Now, one as a contrarian would say, if we've already seen this much red, if we're already in not such a great place on the RSP, what are the odds that we could actually bounce from here? And I think that's a fair thing to say, but it's also a fair thing to say that maybe the S&P could catch down and make its way towards its 50-day moving average. All in all, I think there's reasons to still be bullish into year end. There is definitely a cause for concern right now as well. So let me know what you guys think about this information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.